Hey guys, what's up? Alec back with the daily stock market, and today we're going to be doing a deep dive into three popular high tech stocks. All right, we're going to be talking about Tesla, Microsoft, and some other ones. So make sure you stay tuned throughout this whole video. Stop right now, slap a like on this video. Make sure you're also subscribed with post notifications on so you don't miss any future videos coming up as well. So first up, starting off with Tesla at $1,000 per share, down around 3.5% on Friday and down around 6% on the week. However, we see Tesla up 20% in the past month. And in the last 3 months, Tesla has been pretty volatile to say the least, going from $1,100 per share all the way down to $800 per share, which is around a 30% loss of value. And then from $750 per share, skyrocketing back up to $1,100 per share. So needless to say, anything can happen with Tesla. I have some price alerts set under $900, under $800, and under $750. So if I can get my average cost as low as possible, I really want my average cost to be under $800. So that means I have to be buying super aggressively under $800 per share, because right now my average cost is around $1,000 per share, which I'm very comfortable with my average cost being $1,000 per share or under for long term, because I believe in Tesla for long term. I think they're really just starting to ramp up and get these deliveries started. You know, we've already talked about the Shanghai factory, the China factory, the Berlin, the European factory, and then the Texas factory. They just started making deliveries this year, pretty much. Okay, so once we actually get huge scale with Tesla, obviously it's hard to say what's going to exactly happen with the market cap, but to see a 5x from Tesla in the next 5 years is something that is achievable. It's not out of question. People don't think it could happen because they would probably be one of the biggest companies in the world at that point. But face it, you know, Tesla is going to be one of the biggest companies in the world. At least that's my opinion. If you don't believe that, then you probably shouldn't be investing for Tesla for long term. And I would definitely be waiting for at least $800 per share if you're skeptical on Tesla, or under $800 per share. Okay, so a summary, we see Tesla remains a big cap growth story to watch as we advance. The company revenues and EPS should continue moving higher in future years. Moreover, Tesla has become accustomed to surpassing analyst estimates. Additionally, the company would likely have another stock split soon. Higher stock prices are probable in the future years. Okay, so starting off, we see Tesla has an incredible run over the last several years with the introduction of Tesla mass marketing ultra popular vehicles. The company's revenues have skyrocketed by approximately 13,000% since 2012. Holy cow. Tesla gross profit has surged by roughly 45,000% in the same time frame. Tesla stock has appreciated by an unprecedented 18,000 over the last decade, making it the best performing stock in the previous 10 years. Tesla has become increasingly profitable and should continue to grow earnings and revenue as we advance. The company's stock had a big surge when Tesla announced its first stock split, and now we have the company is about to split the stock once again, providing the company's upcoming stock split, technical setup, explosive growth sales, and earning potential. Tesla stock will likely appreciate considerably in the next few years, in the future years. Okay, so here we see Tesla, a robust technical setup. All right, so here we see some of the moving averages. Let's see what we got going on. The 50-day and then the 200-day moving averages. The 50-day is the blue one. Like most high-profile growth stocks, Tesla took a big hit in the recent tech decline. From peak to trout, the stock dropped by a whopping 44% from its all-time high achieved during the tech blow-off top last November. However, since the bottom, we have seen a meteoric rise of about 57% in Tesla shares. Now we're approaching the highs from last year, and Tesla should be breaking out into new highs going into earnings, and if the stock splits and when it splits. Tesla revenue and EPS estimates I often hear the argument that Tesla is overvalued. If we use traditional valuation metrics like price to earning ratio, Tesla seems rich at around 162 times trailing earnings. Nevertheless, if we look at forward EPS projections, Tesla looks better at 100 times 2022 EPS estimates, yet it's still relatively expensive. However, where else will you find a large cap company growing annual revenues 50 to 60% year over year? You'll be very hard pressed. Moreover, we're likely to see about a 62% year over year increase in EPS this year. Furthermore, rapid growth should continue as consensus analysts estimates are about 15 next year. Okay, so they're killing earnings. They're going to be reporting earnings soon, and the earnings are going to be a home run out of the park. This projection implies that EPS should rise by about 40% year over year in 2023, but the company could beat consensus figures, and we may see EPS closer to $20 next year. Holy cow. In addition, you'll be very hard pressed. You can check a lot of different EPSs, and you'll probably never find a $20 EPS on companies. That's a very profitable company. Next year's revenue should come in at about 120 billion, roughly 50% above this year's projected results. Tesla growth remains remarkable with the force and scale I've never seen. Furthermore, the growth runway remains extended as Tesla plans to introduce new factories, new vehicles, and new revenue streams as we advance. Therefore, Tesla stock may be not overvalued relatively to the company's extensive growth prospects and earning potential. Because remember, they're not just a car company, they're not just a tech company, they do energy and many other things as well. They're even getting into like the robot business. So you can almost think of them almost like an Amazon of the tech world. Tesla's earnings surprises. Tesla's earnings have surged in recent years. In early 2019, the company was still recording significant losses, but earnings took off in the second half of the year. Tesla became increasingly profitable recently, with earnings spiking in the last quarter. Moreover, we see that Tesla has beat 9 of its last 10 earnings estimates, and this uptrend of surpassing analyst estimates should persist as the company advances in future years. In the last 4 quarters, Tesla has beat EPS estimates by 22%, and we may see similar outperformance dynamics as we advance. However, even if we apply a 15% average beat ratio, we arrive with EPS around $12.60 this year. If we add consensus projected 40% EPS growth rate, we come at about $17.64 in EPS next year. Additionally, once we apply our anticipated 15% EPS beat rate, we may see EPS closer to even $20 this year. The stock split phenomenon, which you got to talk about. We've seen many stock splits lately, and the effects have been highly positive in recent years. One of the highest profile stock splits was Apple 4-to-1 split in August 2020. First, the stock has doubled from its coronavirus-induced low going into the split. Then the stock skyrocketed by about 40% in the following months. All right, Apple stock has essentially doubled since its split in 2020. Incidentally, in August 2020, Tesla had its first stock split. The company issued 5-for-1 stock split, and its share price exploded higher. The stock nearly doubled in the coming months, surrounded by the split announcement, and has appreciated by around 600% increase since July 2020. Okay, Tesla 2-year chart. Here you can see the 2-year chart, and we can really see the scale of Tesla stock's price appreciation around the time of the split announcement. Now, I'm not saying we will see another 6-fold return over the next several years, but we'll probably see another leg higher when Tesla splits its shares again. We'll likely see about a 5-10-per-1 stock split, which would bring Tesla's stock price to around $100 to $300 per share. This dynamic would make the company's stock much more attractive for retail investors and for option traders. Here's what Tesla's financials could look like moving forward. So in the future years, 4 future years, we see revenue growing by over 100%, which is more than 30% year over year growth for revenue. We see revenue growth. There it is, 41%, 35%, 30%, 25%. EPS, we see growing to $40 per share for EPS, which would be incredible. Tesla will be one of the most valuable stocks in 2025 if they pull that off. We can see the forward PE ratio going down a little bit more. And you can see the predicted stock price in 2025 is right around $2,500 per share. All right. The risks for Tesla, do exist for Tesla, and there are quite a few. While I estimate that the company can earn close to $40 per share in 2025, the company is very far from such figures right now. Therefore, the risks that Tesla will not illustrate the kind of earnings growth I envision, a slowdown in demand, increase in competition, supply issues, decreased growth, and other variables are all at risk we should consider before betting on Tesla to grow EPS several fold through 2025. Serious concerns could cause Tesla's valuation to lose altitude, and the company's share price could even head in a reverse if any serious issues should arise. Therefore, one should consider the risk carefully before committing any capital to investment in Tesla. So personally, you guys already know where I want to be buying in. Under 800 ideally is the load zone for me. However, I'm a long-term investor for Tesla. I want to be holding till 2025 minimum, and I want to be really holding longer than 3 years. 2028, 2030 are my true goals for Tesla. So if that sounds like something that you're interested in, then your goals might align similarly with mine. And this could even be a good one to throw into 401ks, Roth IRAs, set it and forget it, because at that point you're forced to hold. So Tesla, needless to say, I'm loading up on them in my long-term accounts. I only have 850 in my Robinhood account, but my other accounts, I'm looking to add 3,000, 4,000, 5,000, 6,000 more dollars, somewhere in that ballpark, depending on how low they can go, and if they do get under $800 once again. Other than that, I'm dollar cost averaging consistently every single day in Tesla, no matter what happens, around $10. See here, my $10, that's just on Robinhood. And you can see increase of about 13% from dollar cost averaging in, and then probably another $10 on my other account. So probably around $20 per day, dollar cost average into Tesla. So needless to say, I definitely believe in them for long term, and they'll probably be one of my biggest positions in the future, especially if they keep growing their share price. So the next one that we're jumping into is Microsoft with 24 million in volume, up 4% in the last month. They're headed towards a 3-month low of $275 per share. And you can see from all-time highs of $340 per share, they're down roughly 13% currently. Okay, now there's a strong possibility that Microsoft will pop back up around $310, $315 per share once again. I want to be loading as close to 275 as possible. It might go under 275, so that's what I'm really looking forward to. However, I am dollar cost averaging in $5 per day on something like Microsoft, and you can see I have $169 of market value, and the PE ratio is 31. The market cap is one of the biggest companies in the world, if not the biggest company in the world, at $2.2 trillion. So let's dive in a little bit deeper and see what's going on under the hood with Microsoft. Okay, let's try to go a little bit faster over Microsoft this time. So summary, you can see Microsoft reported once again a strong quarterly results and could grow its top line and bottom line with a high pace. And we can expect Microsoft to continue grow in the coming years, and the potential acquisition of Activision Blizzard will contribute to that growth. Microsoft has an extremely strong balance sheet and a huge amount of cash and short-term investments, which is a great thing for any safe company to be investing in, the stock could be fairly valued right now. All right, so you'll see while several technology companies have declined pretty steep in the last few months, including high flyers of the pandemic like Zoom, but also technology giants like Facebook and Tencent, Microsoft is still performing solid, but we can't deny that Microsoft also declined in the last few months and almost entered bear market territory. Remember, it's down around 13%. So quarterly results, when looking at the last few years, Microsoft could improve its business, and since financial 2018, the company can report double-digit revenue growth every single year, with the growth rates fluctuating between 13% and 17%. Wow, which is huge, huge, huge growth, 13 and 17% for a company that's already a $1 trillion business. And when looking at the last 4 years, operating income could increase even 20 to 30%. The pandemic was clearly a tailwind for Microsoft, with even higher growth rates than its quarters before the pandemic. And so far, we see no signs of growth slowing down. When looking at the last quarterly results, we can see strong growth rates for Microsoft. Total revenue increased from 43 billion in the same quarter of last year to 51 billion this quarter, an increase of 20% year over year, which is a revenue monster. So congratulations to them. And that's a really good look on their part. When looking at the two different sources of revenue, continued growth, and we can expect that Microsoft will continue to grow with a healthy pace. At this point, it seems not unlikely that growth will continue for different segments, especially revenue from cloud. It expects to be an important driver of revenue growth over the years to come. When looking at growth rates analysts are expecting in the years to come, we see rather high numbers over the next 10 years. Analysts expect earnings per share to grow with a compounding annual growth rate of 16%. Okay, now acquisition of Activision Blizzard was very important. On January 18th, 2022, Microsoft announced the acquisition of Activision Blizzard for $95 per share. An all-cash transaction valued at $68 billion, one of the largest acquisitions ever. The deal is expected to close in Microsoft fiscal 2023. Activision Blizzard, with 10,000 employees, is serving nearly 400 MAUs, monthly active user, playing games like World of Warcraft, Diablo, Call of Duty, and Warcraft as well. As a result of acquisition, Microsoft will become the third largest gaming company in the world by revenue, behind Tencent and Sony. Spending almost $70 billion on an acquisition seems like a huge deal, but we must always keep in mind that Microsoft is a business with a market cap of $2.3 trillion, and Activision will therefore contribute strongly to the revenue growth that they need. Balance sheet, when looking at the balance sheet, Microsoft has the financial stability to acquire Activision Blizzard without much trouble. On December 21, Microsoft had $2 billion in cash and cash equivalents and $1 billion in short-term investments, about a 50% ratio. These are clearly enough liquid assets to acquire Activision. So a conclusion on Microsoft: it is a great business with one of the best moats a company can have. The different business segments are profiting from switching costs, networking effects. Of course, the brand name is also adding to the competitive advantage for Microsoft. Additionally, Microsoft has a strong balance sheet and will most likely continue to grow with a healthy pace. And in my opinion, Microsoft could be fairly valued right now, but it's probably not a bargain at this point. We really want to see that price under $270 per share. However, if we jump into what the analysts are saying about Microsoft, you can see an average of $374 for a price target to sell at in the next 12 months, which was a 26% upside. And if we look at where some of these analysts are coming from, now they haven't reiterated this in a while. It's been a couple months. But you can see there's a lot of 5-star analysts coming in, and a lot of them are from respectable places as well. So around $300 per share, $350 per share, and closer to that $375 per share is a good selling point, a good target, a good price target for Microsoft in the next 12 months. And the last one is Facebook. We're running out of time, so we'll go a little bit quicker on this one. However, we'll come back on a future video for a full deep dive on Meta platforms or Facebook. So if you want to see that video, make sure you're subscribed with post notifications on and share this video with a friend if you think they'll find it helpful. In the last month, they're up 14%. In the last 3 months, Facebook is down 31%. So it's still down considerably. It hasn't recovered. And it's down 41% from all-time highs. So if you're looking for a bargain, this one might be one of the best ones to be looking at. Okay, so first up is their net income. This is Facebook. We're talking about growing net income considerably every single year. What company do you know? 78%, 21%, 57%, 35% growth on net income every single year. Now, we saw 2019 a little bit of a hiccup, down 16%, but a lot of businesses took a hit in 2019. Okay, now we jump over to total revenue. What other company do you know? 47%, 37%, 26%, 37% growth every single year for the last 5 years, and they're still down 40% at the same time. Now, the balance sheet is what I really, really like about Facebook, and this is why I'm so confident and feel really secured by investing in Facebook. Not only are they a bargain like we talked about, they have good net income, total revenue. They get an A+ for both. You'll go to the balance sheet and look at that. Their total assets are $165 billion and their total liabilities are only $41 billion. So they have a 24% ratio, which most companies don't even have under a 50% ratio. So if you can get under 30%, that's a stellar balance sheet. That means that you have more than 3 times the amount of assets than they do liabilities. For Facebook, for instance, they have over 4 times the amount of assets as they do liabilities. So if anything happens on the company and they, have hardships or hard times and they're faced with debt, Facebook has almost zero risk of going out of business, or Meta Platforms, I should say, has zero risk of going out of business because they can easily pay off all their debts with the snap of the fingers, and it wouldn't even touch their cash and cash equivalents and their, stuff overall. Just in cash and cash equivalents, they have 16 billion. Short-term investments, they have 31 billion. So just from their short-term investments and their cash and cash equivalents, they can easily pay off all their debt, 100% of their debt, if needed. Something like that, in my opinion, is not going to be needed and it's not going to happen. That's just a worst case scenario, a good thing to look at. But if we jump over to what the analysts are saying, we see a 46% upside on average over the next 12 months. We see a $325 price target, which I agree with that price target spot on for the next 6 to 12 months. And we can see some of these ones were even reiterated 6 days ago, 11 days ago, 13 days ago, all from 4 and 5 star analysts. So some good analysts coming in, not reiterated too long ago as well. Overall, Facebook's probably one of the best bargains in the stock market right now. However, they do have short-term risks, but the long-term risks really are not there because they have so much cash and short-term investments and their balance sheet so spectacular, their revenue growth spectacular, the income growth spectacular. There's nothing really wrong with Facebook as a company at all, or Meta Platforms. And if you can get in, if I can get in under $200 per share, that's where I'm really going to be loading the boat on Meta Platforms. Smash a thumbs up on this video if you appreciate the content just like this. Share with a friend if you think that they will find it helpful. If you want to get on my close friends list, message me here on my Instagram, The Daily Stock Market. I post all my buys, all my sells, when I'm buying, how much I'm buying, how long I plan on holding, and where I plan on selling at, and how long it'll probably take. I also post a few option calls on my close friends list every single week. So if you're interested in getting better at option calls, or if you're a beginner just looking to get involved with the stock market and to become more advanced with the stock market, I also have beginner programs and beginner courses for people that are brand new to the stock market. So reach out to me there. I take the time out of my busy day to respond to every single person, and I'll even shoot you over my website so you can check everything out for yourself. All right, guys, just like this video if you want me to keep making content just like this. Share with a friend. I'll see you guys in the next video. Remember, don't time the market, buy the market. Peace.